The US dollar has been rising against the Canadian dollar in recent days, and it's now approaching a key area of resistance. The dollar CAD pair has actually been trending between 130 and 134 for quite some time now. The path to the downside has looked more vulnerable than that to the upside, but we have seen this pair pick up some upward momentum over the last few weeks. Now, I think there's a culmination of factors which have really contributed to this. We are seeing a little bit of dollar support at the moment, but I think more importantly, it is that Canadian dollar which is contributing more to the rally in the US dollar Canadian dollar pair. A little bit of softness in the Canadian dollar really helping to elevate this particular currency from around the 130s where we were trading previously back up towards that kind of 134 region. Now, in the past 48 hours or so, this has been exacerbated. We have seen a much stronger move higher in this particular pair over the last 48 hours. And I think there's a few factors which have really contributed to this, particularly in the last 24 hours. And I think a lot of this centers around oil in particular. In oil, we have seen Brent and WTI crude actually slipping. Now, we do see a large correlation between oil prices and the Canadian dollar, and therefore a slip in oil prices has contributed to a slip in the Canadian dollar as well. And again, I think there are a few factors behind this. One has been speculation that OPEC and the non-OPEC allies like Russia are unlikely to actually increase production cuts at the meeting in March. Now, the current production cuts could potentially be extended into next year, but in this current environment, there is questions being raised about whether they are sufficient enough to actually reduce the oversupply that we are seeing in the markets, especially at a time of waning demand. So that has taken some of the pressure off of oil prices. The other factor is that trade talks between the US and China do appear to have slowed. We are seeing a lot more commentary now from both sides, coming from the Chinese state-owned press, suggesting that tariff rollbacks are essential as part of any deal, but then also from the White House as well, that despite the positive comments from the likes of Larry Kudlow, the commentary coming from Trump himself is certainly around not rolling back current existing tariffs. This is the US leverage ultimately in these trade negotiations. This is why the tariffs were imposed initially. So the idea of rolling back the tariffs as part of a phase one trade agreement is not appealing to Trump. But then the question raises, how does a deal get over the line without some compromise on both sides? There was reports a few weeks ago that the US was considering rolling back around $112 billion of tariffs. But again, this is something that was rejected at the time by Donald Trump. So clearly there's still plenty of discussions to be had. Clearly Trump himself was very premature last month in announcing that a trade deal or a phase one trade agreement had been reached. There's still some details to be overcome. It was meant to be this week that we were meant to see this deal signed at the APEC summit in Chile. Then it was touted that it could come at the NATO summit at the start of December, and even this looks extremely ambitious at this stage. So the fact that we are seeing optimism around this starting to soften slightly as the week has gone on has taken some of the pressure off of oil. Of course, the trade war has largely driven the global economic slowdown that we are currently experiencing, and China is such a massive consumer of oil. Any easing in tensions between the two countries was always going to be positive for its economy and therefore its oil consumption and therefore again oil prices. The final thing that contributed to the lower oil prices overnight was that API reading. We saw a large build than we were expecting, which suggests less demand and again more supply, which takes some of the pressure off. So the culmination of those three factors hit oil prices over the last 48 hours and therefore in turn weighed on the Canadian dollar, pushing it back towards the top end of the range around 134. Now, if we see a break through that 134 level, this would put us back in much more bullish territory. We waited a long time for this break lower. We saw this rising trend over the course of more than a year. So we waited a long time for that to initially break lower a couple of months ago. So I think it is going to take a very significant move to take us through that 134, and it would send a very strong signal if we do see that. Alternatively, that 134 could provide a significant amount of resistance for the currency pair, so we could potentially see some profit taking as we approach this level, which is why the momentum indicators are extremely key, and that could potentially lead to a rotation off of those peaks and a continuation of this range trade that we've seen in the dollar CAD pair between 130 and 134.